Now, so let's move on and welcome in our next guest. Jitendra Gohil, Chief Investment Strategist at Kotak Alternates, is with us now. Jitendra, great to have you. Thanks for joining in. I think the bulls are just heaving a sigh of relief, right? We've got 2 green days on the trot. If today is, also a positive close. What's your best guess? I mean, first market-wide view. Have you been nibbling in to this fall, or have you been keeping your powder dry, waiting for lower levels?
Hey Surabhi, hi. Thank you for inviting me on your show. So, a couple of things that we are observing right now, and we are a little cautious as of now, and we have been deploying for sure, but with a gradual deployment plan. That's what we are doing as of now. There are a few things that we are observing very keenly. One is the U.S. bond market. If I look at from September onwards, the U.S. yields have gone up by almost 120 basis point, and even the dollar index is up almost 8-9%. In these kind of scenarios, generally the emerging market tends to underperform. But what we feel right now is that there's too much hope is built in into US markets. So most of the investors have concentrated their all the bets in the US market. There are some reasons to believe that this market is going to do well. However, there's too much of optimism, as we believe, that is now baked in the US market. And the moment we starts to see some kind of slowdown in US, and remember, it's not everything so all right in US, right? So the debt to GDP is running at almost closer to 130%. And they're talking about cutting government spending, which might lead to domestic market slowdown. And US cannot be seen in isolation because it generates a lot of revenues, a lot of profits outside US also. So if other markets are going to see economic concerns, then even the US market will have to slow down. The moment that we see that these kind of factors starts to show signs, I think we will see US market will take a breather and money will come to emerging market. But till then, I think the Indian market, given some minor slowdown that we saw in the previous quarter, and obviously the earnings cuts that we saw in the previous quarter, has led to some sentiment deterioration. And hence, we are a little cautious. We think that the worst part of the macro slowdown is over in India, most probably. And from here onward, we might see some acceleration. And given our view that US market is now coming to a very stretched kind of levels, we feel that in the next couple of months, there should be some stability. So we are using this correction as a buying opportunity.
Jitendra, hi, afternoon. So what exactly are you buying? How's your portfolio constructed right now?
So Reema, so we are taking a balanced approach. Earlier, it was a very, it was very clear that look, government spending is improving, investment to GDP ratio is improving, and government was very clear that they want to do all the supply side reforms to control inflation, and that's the kind of view for the past 10 years since 2014 that there's a huge focus was on infrastructure. But slowly, gradually, if you've seen, a couple of years, we have been talking that, look, spending 11 lakh crores by the central government is not easy. And to expect that every budget, this capex spending will go up another 10-20%, I think that's very tough ask. So we feel that government spending in infrastructure will go higher, but the pace of growth in infrastructure will slow down, and that leads to some more headroom to improve the consumption part and where the economy really needs that. So we think from a portfolio perspective, now we are balancing the portfolio. Earlier, it was highly tilted towards most of the domestic cyclicals in all these sectors. Now, slowly, we are moving towards the consumption part. I'm not saying consumption pain is over, but we feel that sooner or later we will see some consumption recovery, and there are some green shoots visible, right? So if I look at the rural side, the monsoon has been pretty okay. This time, the Kharif output is expected to be somewhere around 4% and also the Rabi season is expected to be good. Inflation in food has started to ease, and I feel that look, this is a good time to look at some of the stocks which have battered down really bad in the previous cycle. So I think consumption recovery is going to take place. So there we are a little bit more constructive. Slowly we are building exposure there. Structurally, we believe that pharma is a sector because looking at the inflation in US, the healthcare cost in US has been concerned. And I feel that some more business opportunities might come to India. some of the CDMO players, contract manufacturers have started to
Right.
perform really well, and we are concentrating our bets on the pharma sector as well. And
Okay.
lastly, from the financial side, we are a little bit cautious here. The growth is slowing down, margins are under pressure. So we feel that there are certain pockets in the financial sector, such as CV financiers, we have been accumulating. We also believe some PSU banks which have corrected. So there also some buying opportunity might emerge.
Okay, all right. Jitendra, let's focus on the consumption part first. What will you be looking to buy? Staples?
Hey, Nigel. Consumption staples, staples could be a kind of a short-term play in our view, looking at the rural recovery that we are talking about. But structurally, we feel that staple companies are going to see margin contraction. Last 7, 8 years, if I look at the kind of EBITDA margin expansion these FMCG companies have seen, now is the time when the demand is not picking up and government is reluctant to go for a massive consumption stimulus. It's very obvious that these companies will have to reduce their margins and improve their volumes. So in the near term, probably a nice 10-15% bounce expected. But from a structural perspective, we are a little cautious. In terms of other consumption or driven sectors, we are really positive on travel tourism kind of a sector. I think airline companies, because 10% rise in oil, companies have corrected. I think these sectors are looking pretty okay. Somewhere, if we go one step forward, real estate, there also we feel that the interest rate cut outlook has now changed, and central banks have become a little bit hawkish, looking at the strength in the U.S. economy. But we feel that India might want to go for slightly easier monetary policy in 2025, and given these kind of correction that has happened in the real estate, including the mall operators, so we are also very positive that consumption is going to rebound, and real estate segment will remain pretty resilient in the current year. And the stocks have also corrected. So these are the pockets in consumption that we are bullish on.
Okay, got that point, Jitendra. So now let's talk about the other end of the spectrum, right? You were talking manufacturing and you mentioned CDMO. So let's get back to that. Just expand on that, given that we are in the budget, and if you are expecting some sort of a further push to manufacturing, capex, how would you play it? And also, some of the stocks now have cooled off in this correction. Some of the valuations have come down. So what would you pick?
So, Surabhi, it's very clear that last 9 months or so, I would say that the government spending has slowed down materially, right? And recently there was some announcement that the government is, handing over more cash to the state governments, and government is clearly struggling to spend. It's not easy to spend so much amount, and we think that government spending might accelerate. And I think power sector is a structural story in India. So if I get stocks which are down 30-40% and outlook is positive, we are a little bit positive on the power infra space, where we feel that there's still good headroom for the next few years to look at having a little higher outperformance. The second story that we feel is the railways, but I think there we are really concerned about the kind of valuations. So while we feel that government spending might be okay and good, but I think the stocks are extremely overvalued. Defense
And
is
what
the
about
story
defense?
that we are bullish on. Yes, defense we are bullish on, but barring couple of stocks that we are very confident, we think that most of the stories are already pricing in 3, 4, 5 years of outlook. So we are cautious about the valuation. Government spending in infrastructure, defense will remain elevated. However, the acceleration we are not expecting, and hence I think most of these stocks which have 4x, 5x, we are avoiding it. We are only going for some of the very key stocks that we are confident about their valuation and margins.
Quick word on IT, because on one hand, they're sitting on large gains over the last 2 years. But this is a sector which, at least for the large caps, is only growing at mid to high single digits. But then on the other hand, it's also seen as a bit of a macro trade with the rupee depreciation and acting as a bit of a defensive. So where do you stand on IT?
IT, we are neutral, so we are not underweight at all. We think that, look, US is doing pretty good. The commentary from IT companies in the next couple of quarters have actually improved, right? So we feel that from here onward, IT QoQ basis on a quarter-on-quarter basis, we think you will see some more improvement. Hiring outlook has also picked up, so we are actually more positive on hiring companies or manpower companies compared to IT in the first place. And large cap ITs, yes, we believe that it will be a 10-12% story. But looking at the global tailwinds that US is going to see because of tax cuts, because of higher growth, we feel that sector one should stay invested. Coming to mid-cap IT, I think it's a different ballgame altogether, and there we feel that there are plenty of opportunities. I think the stocks have corrected, outlook is strong. So I feel that IT overall neutral, but we will go for some mid-cap IT names over large-cap IT names, at least in the IT space, which will also give you some, hedging from depreciation in rupee and stronger US economy than expected.
Okay, all right, Jitendra, appreciate you joining in and giving us all of those cues on market as well as sectors and themes that you like. We look forward to chatting up with you rather soon.
Thank you.
Thanks a lot. Well, before we slip into that short break, guys, I just want to pull up a